is a mutual fund? And do people still buy mutual funds with all the new financial products that are being launched every day? Hi everyone, I'm Ava, and welcome back to Your Financial Journey. Recently on this channel, we covered what passively managed index funds are. But there's another type of fund that might be just as popular and important for your long-term financial goals: actively managed mutual funds. So today, we'll be diving into what a mutual fund is, the main types of mutual funds, and the differences between actively managed mutual funds and passively managed index funds. Let's get started. What is a mutual fund? In its simplest form, a mutual fund is a fund in which money from many different investors is pooled together into one portfolio to mutually share ownership and any profits or losses. The way it works is that hundreds or thousands of investors contribute their money into one larger portfolio, with each investor owning a small piece of that portfolio. Mutual funds are often, but not always, professionally managed, actively managed as the financial industry calls it, and they can include almost any kind of asset, such as stocks, bonds, or commodities. People may invest different amounts of money into the fund, but each person will own the same proportion of each asset. For retail investors, mutual funds can give you access to a diversified portfolio and professional management that would otherwise be hard or overly expensive to access. An individual may not always have enough money to buy many types of assets, but in a mutual fund, managers are able to use investors' combined capital to buy more assets and then divide their value among the owners of the fund. Mutual funds are created by fund sponsors, large companies like Fidelity, Schwab, or Vanguard, that decide to launch a new fund with a specific goal. That might be anything from investing in the most promising AI or healthcare companies to looking for the highest paying dividend stocks or highest quality bonds. Sometimes, a mutual fund may also track a market like the S&P 500 and be considered an index fund as a result, but more on that later. The sponsoring companies need to file paperwork to get their mutual fund approved by the SEC, the Securities and Exchange Commission, after outlining their strategy, risks, fees, and objectives. Once a mutual fund is approved, portfolio managers will begin making investment decisions while shares of that mutual fund are created and sold. These shares will be sold to potential investors, and with the new money a fund receives, more assets will be purchased. And when an investor decides to sell their shares, the mutual fund may sell some of their assets to pay them out. Something important to note is that unlike shares on an exchange, which you can sell for the market price whenever the market is open, mutual fund shares are priced only once per day at the net asset value, or NAV. This NAV represents the value of one share of a mutual fund, and they're generally updated after the market closes. So if you place an order during the day to sell a share of a mutual fund, you'll generally receive its NAV value in cash at the end of the day or on the next morning. Those are the key things you should know about all mutual funds. But not all mutual funds are the same. And that takes us to, what are the main types of mutual funds? Just like with index funds, there are countless different ways of categorizing mutual funds. But for this video, I'll be explaining 5 of the most commonly mentioned ones. And perhaps the biggest distinction to understand is between 1. Active and passive mutual funds. Active mutual funds are, as the name implies, actively managed by a portfolio manager or team. The fund management would actively research and pick certain assets, usually in an attempt to outperform the market. These types of mutual funds tend to have higher fees and may deviate more from the general market trends. Passive mutual funds, on the other hand, don't have management making active choices about when to buy or sell. Instead, they often act as index funds, tracking a certain market like the S&P 500 or NASDAQ 100 without the management intervening much. These are also known as index mutual funds, and they're more likely to have lower fees and match market returns. So passive mutual funds may often, but not always, be index funds. But not all index funds are mutual funds. But more on that later. 2. Asset-based mutual funds. Many mutual funds invest primarily in one specific type of asset, usually for a defined long-term goal. Stock and equity funds for growth, for example, or bond funds for stability and regular interest payments are some of the most popular ones. These asset-based mutual funds can be actively managed, but they're also often index funds based on markets like the S&P 500 or the US bond market. For instance, Schwab's S&P 500 Index Fund, ticker symbol SWPPX, is an example of a stock-based mutual fund, while Fidelity's US Bond Index Fund, ticker symbol FXNAX, is an example of a bond-based mutual fund. In addition to these, mutual funds for real estate, commodities, or other assets may exist as well. 3. Asset allocated or balanced mutual funds. These types of mutual funds, rather than focusing on one specific asset, mix different types of assets in certain proportions. The goal behind this is to help you balance risk and diversify your investments, instead of having your investment concentrated in one type of asset. The most common variations of this are balanced or mixed stock and bond funds, which attempt to balance growth in their portfolio from stocks with stability from bonds. Vanguard's Balanced Index Fund, ticker symbol VBIAX, is one example of such a fund, with 60% of assets invested in the broad U.S. stock market and 40% of assets held in the investment-grade U.S. bond market. There are also certain asset-allocated mutual funds called target date mutual funds, designed for retirement in a specific year, hence the target date. These mutual funds are made up of a mix of stocks and bonds, and as they near their respective dates, they automatically adjust to increase their allocation of bonds for more stability near retirement. For instance, Vanguard's Target Retirement 2060 Fund, ticker symbol VTTSX, has a target date of 2056 to 2060, so you might invest in it if you are planning to retire around that time. As Vanguard describes, such funds provide broad diversification while incrementally decreasing exposure to stocks and increasing exposure to bonds as each fund's target retirement date approaches. Leave us a comment below if you would like to learn more about target date funds. 4. Sector funds. Some mutual funds concentrate on specific industries, like technology or healthcare. These funds have the potential to offer higher returns, but they also tend to have higher risk because the entire industry could be affected by an event. For instance, Fidelity's Select Technology Portfolio, ticker symbol FSPTX, is an actively managed tech-based mutual fund. This focus means that the fund may potentially offer high returns if semiconductor and AI companies continue to perform well. But it also means that the fund may potentially be at risk if, as many people believe, there is an AI bubble that may burst any time. And 5. Money market funds. A money market fund is a special type of mutual fund that's meant for low-risk, short-term investing, almost as storage before you decide what to invest your money in next. The idea behind these is to keep your money liquid while paying you at least a bit of interest on it, rather than having it sit in an account with low or even no interest. Some brokerages may automatically sweep your cash into money market funds if it's uninvested. Again, these aren't the only ways to categorize mutual funds, and many mutual funds may fall into multiple categories. All mutual funds, for instance, can be categorized as either active or passive, which was our first distinction. While it depends on the specific fund, passive mutual funds may often be index funds, such as Schwab's S&P 500 Index Fund. These types of funds are both index funds and mutual funds. However, actively managed mutual funds are generally not index funds. The two are their own separate investment strategies with distinct features. And to clarify what those differences are, let's move on to the next section of today's video. What are the differences between actively managed mutual funds and passively managed index funds? Here are the 5 key differences between actively managed mutual funds and passively managed index funds. In this column, we'll list the aspect that creates a difference between the two types of funds. In this column, we'll describe how this aspect functions for actively managed mutual funds, and in this column, we'll describe how it functions for passively managed index funds. So the first difference is management style, which you can probably tell by each fund's name. The mutual funds we're talking about are actively managed, so a professional manager or team makes decisions on what stocks, bonds, or other assets the fund buys for its portfolio, and they can adjust the fund's portfolio as often as they want. On the other hand, like I mentioned earlier, index funds are passively managed, so the fund owns the same assets as the index it's tracking, and the portfolio is only adjusted if the index changes, which is usually not very often. This difference may make the returns of index funds more reliable for many retail investors, as they're based only on market performance rather than human decisions. And whether humans are needed to take the big decisions or not also has a big impact on our second difference: costs or the expense ratio. Actively managed mutual funds generally have higher costs, often with an expense ratio of 0.5 to 1.5%, because you're paying extra for the human oversight in these funds. Index funds, however, generally have lower costs, with passively managed index funds' average expense ratio being 0.05% on average in 2025, according to Fidelity. That difference can add up over the long term, but the expense ratio isn't the only factor affecting the net return for the investor, because the third difference between actively managed mutual funds and passively managed index funds has to do with taxation. Without making things too complex, mutual funds usually incur higher taxes because of more frequent buying and selling of assets, as the fund's management may be constantly overseeing and adjusting the fund's holdings. Index funds, on the other hand, usually incur lower taxes because assets are bought and sold less frequently. The fund only readjusts in response to changes in the index, and this rebalancing is generally not as frequent or large as that of a mutual fund. Next, the fourth difference regards flexibility, or pricing frequency. With actively managed mutual funds, you can only buy or sell, or redeem, a share once a day, usually in the late afternoon after the market closes, and they are always priced at the net asset value or NAV, the book price of the assets if you want, as I mentioned earlier. So even if you want to sell a mutual fund share during the day, the transaction will usually only be processed after the market is closed, and you will receive your money only at the end of the day or even on the next morning. For index funds, there are two options. It's possible that A, the index fund is a mutual index fund that you buy and sell or redeem only once a day at NAV. As we discussed earlier, index funds are mutual funds, and if this is the case, the flexibility or inflexibility will be exactly the same for an actively managed mutual fund. But it's also possible that B, the index fund is an ETF or exchange-traded fund whose shares can trade during the day. This can get complex, but put simply, this means that you can buy or sell a share in an ETF anytime while the market is open, but the price will be whatever the market says it is. The big difference to a mutual fund here is that you can trade an ETF share with another willing buyer or seller on the exchange without having to go through the issuer, like for a mutual fund. And the fifth difference regards the expectations that each fund has. Actively managed mutual funds generally attempt to outperform the market, although many industry observers would argue that most actively managed mutual funds fail to do so on a consistent basis. This may make actively managed mutual funds even more unpredictable, and it's hard to guarantee if you'll get even the equivalent of market returns. Index funds, however, usually generally attempt to match the market return, minus a small fee, making them more reliable for many investors. By investing in an index fund, you're not taking any extra risk besides investing in the market, and you know that you'll get almost as much as the market returns, both gains and losses. These 5 differences are important distinctions to be aware of, but remember that this comparison is most important when choosing between actively managed mutual funds and passively managed index funds. Some mutual funds may be index funds themselves, and there are other options that may not fit perfectly in either category or be a mix of the two. And to answer the question from the very beginning, do people still buy mutual funds? The answer is a resounding yes. According to the Investment Company Institute, or ICI, a leading industry association, there was $31.4 trillion invested in mutual funds in the US in 2025. What do you prefer? Mutual funds or index funds, and why? Do you have a favorite mutual fund? Drop a comment below to let us know. Make sure to like and subscribe if you enjoyed this video, and check out this deep dive here on index funds if you want to learn more about money and investing. Thanks for watching, and I'll see you next time.